Hi all, this is Akshara Menon from PMS Bazaar. I take a pleasure in inviting you all for yet another round of a webinar on the topic why fixed income with Nifty at 20K. We all know that fixed income PMS offer a way for investors to grow their money by investing in different types of fixed income assets like bonds, debentures, and treasury bills, etc. This service is managed by the professionals to suit different risk levels and financial goals, focusing on stability and regular returns. To know more about it, we have three speakers for the day. Let me start off with Mr. Joydeep Singh, sir. With over 25 years in finance, Mr. Joydeep is an esteemed corporate trainer, columnist, and author. He held a senior vice president position at BNB Paribas before pursuing his passion independently. Mr. Joydeep has authored four acclaimed books and published nearly 500 articles in top financial publications. He's a certified financial planner and a sought-after trainer for renowned financial institutions and universities. Moving on to the next speaker of the day, Mr. Vaibhav, an electrical engineering graduate and an MBA in finance, who's 17 years of experience. He spent a decade at ICICI Bank in their treasury team, specializing in forex and fixed income. Currently, as a fund manager for fixed income PMS at PhillipCapital, he focuses on organization and handling fixed income products for clients. Moving to the last speaker of the day is Kunal Singh Kochar. Mr. Kunal, with rich 22-year career, holds a degree in commerce and international business. Beginning as an equity dealer at Tata TD Waterhouse, he moved to PhillipCapital in 2003. Mr. Kunal recognized the demand for incredible direct fixed income product and was instrumental in launching PhillipCapital's fixed income desk. His efforts led to the firm to leading providing fixed income solutions for wealth management firms, including corporate funds. So before giving the podium to Mr. Kunal, I would request you all to put the question in the Q&A box and not on the chat box. Over to you, sir.
Thank you so much, Akshara, and good evening, everyone. Firstly, I'd like to thank you all for taking the time to attend the webinar, Why Fixed Income with Nifty at 20K. Looking at the number of people who've joined the call today is extremely encouraging, especially given the way equity markets are currently performing. I recall when we had a discussion with the team at PMS Bazaar a couple of weeks back. Nifty was sub 20K, and today when we are doing this, a more appropriate title should probably be Why Fixed Income with Nifty at 21K. So just taking you through the format. The format of today's event is going to be, initially I'll give you a brief introduction about PhillipCapital. Subsequently, Joydeep will take over and give you his perspective on rates, the credit environment, and asset allocation. Then I'll run you through a brief product deck, which will introduce you to a vehicle that you can consider for your fixed income investments. And once we complete the product deck, we'll open the floor for questions, where Joydeep, Vaibhav, who's our fund manager, and myself will try and answer all the questions you have. So I request you to kindly make note of all your questions and share them on the chat. So to start with, I'll give you a brief introduction to PhillipCapital. The Phillip Group is headquartered in Singapore and has a presence across 15 countries. The group is privately owned and has varied business interests in each of the countries that they are. We are a leading broker in many geographies. We are also an asset management company with about $47 billion in AUM. We provide custody services. We are a bank in some of the geography that we are. We are an insurance company. We are in the forex business. So the group is quite well prevalent in especially across Asia and Europe, with a presence stretching from Australia all the way up to the United States. The group services about 1.3 million customers globally, and we pride ourselves on the fact that we have no long-term debt, but rather about $1.8 billion of shareholder equity. Now, talking to you about the India business, the India business has been an active participant in local markets for the last 2 decades and counted amongst the market leaders in what has been our core area, that is the institutional equity derivative segment. In addition to being an equity and commodity broker, we are also a depository participant with NSDL and CDSL. We are a Cat 1 merchant banker. We are a fixed income services provider. We are a spot forex broker, an insurance distributor. We run a AIF from GIFT, and also a very successful equity PMS for the last many years. The institutional business, the institutional broking business, which has been a backbone of our presence in India, is supported by a large research team that services some of the largest local and global investors. Some of these investors include some of the largest global institutional counterparties, including banks, funds, and others. We are hoping to use our strong research and analytical capabilities to benefit you all in all areas, including fixed income. With this background, I hand over the baton to Joydeep, who will take you through part 1 of our presentation.
Thank you, Kunal, and welcome friends to the call, and wish you a fruitful evening. We hope to give you value for the evening. So I will talk about the macro perspective, as Kunal said, and I will start with allocation. Yes, I know you have heard this earlier. You have heard this many times, but still I will show you some data and give you some perspectives. So I have taken 3 asset classes: equity, fixed income, and gold, for the sake of simplicity. So in this graph, the blue bars represent equity and the maroon bars represent debt. So equity, as you can see, has been volatile. So for example, 2008, that so-called global financial crisis, 2009 recovery thereafter, then it has been up and down, and debt has been mostly stable. Here, what I'm showing you is you can see the 3 curves. The orange curve represents 3-year SIP in CRISIL Composite Bond Fund. It may seem like an average of mutual funds, but no. It is a portfolio which CRISIL thinks should be the portfolio of a typical bond fund. So this is a 3-year return, not just a day-by-day return. The dark blue line is 3-year SIP in Sensex TRI, that is Total Return Index, and the light blue line is the 50-50 allocation. So what am I showing you here? If we have a equity-only allocation, you can see this dark blue line, and you can see the 0 line here. During COVID period, this dipped below the 0 line. You will recall Jan-March 2020, the market went to a steep correction, 38% at the index level. So in this phase, look at the orange curve. The orange curve is stable, in fact, sloping upwards. So the essence is, if you have a equity-only portfolio, at the end of it, yes, you end up with the highest returns. But if you have a 50-50 portfolio, you have a smoother journey. Returns somewhat lower than equity only, but the journey is that much smoother. Now spend some time here. What I'm showing you here is, towards my left is the equity only returns. Now this is a long period. So this is average 10-year CAGR over a long period of 1997 to 2019. Over this long period of time, if you had an equity only portfolio, you would have earned a CAGR of 14.3%. If you had a debt only portfolio, you would have earned a CAGR of 9.1% and gold only 11.4%. If you had a 50-50 portfolio, 50 equity, 50 debt, you would have earned 11.5% CAGR. And towards my right, if you had a 45-45-10 portfolio, 45 equity, 45 debt, 10 gold, then you would have earned 13.2% CAGR. What's the message? Over this long period of time, if you had a properly allocated, properly diversified portfolio, 45 equity, 45 debt, 10 gold, you would have earned 13.2%, which is, okay, mathematically lower than 14.3%, but only that much, maybe 1% or thereabouts, little lower than equity, but the volatility is much lower, and you can see the dotted line, that is the Sharpe ratio. So the risk-adjusted return over a properly diversified portfolio is the highest here. And that is the argument for running a diversified portfolio and not just an equity-only portfolio. Now, before I come to the interest rate view per se, the data I'm showing you is the growth projection. So at this point of time, globally, growth is a question mark. So I'm showing you the IMF projections. It came in October this year. So in 22, the world grew at 3.5%. 23, the projection is 3, and 24 projection is 2.9. Now look at the second line. 22, advanced eco, growth was 2.6, and 23, 1.5. It is a steep deceleration from 2.6 to 1.5%. 24 also, it is 1.4% as per IMF projection. And within that, look at this, Germany, the frontline economy of Eurozone. For 23, the projection is minus 0.5%. The data we are getting, Eurozone GDP growth rate is not good. So this deceleration is growth is a case for the central banks all over the world to ease interest rates. Saving rates, here you can see emerging market, developing economies. So China growing at 5% or 4.2%. India, you know it, growing at, today only we had the RBI projection at 7% for FY24. So with that, I'll give you a gist of the interest rate movement. So this is the US Fed, COVID period, steep rate cuts, they maintain it here. Then 22 happened. In 22, what happened? Just to recap, the Russia-Ukraine war, supply chain disruptions, inflation shooting up all over the world, and central banks all over the world had to steeply hike rates and also had to at least start taking away the flood of liquidity they had pumped in earlier. So you can see the ladders here. The US Fed is pumping up their Fed rate. Okay. Now, talking of the projection or talking of the likelihood, on one hand, the US Fed, they have their official projections, they have their official communication. On the other hand, we are going by the market view. Now, what is this market view? There is something called US Fed Funds Futures. And from the US Fed Funds Futures, the market imputes the probability of rate action. Today is 8 December. On 13th December, we have the next US Fed meeting. And the market is saying 100% probability of a rate maintenance. That is, it will remain in the 5-quarter, 5-half rate in the review meeting on 13th of December. I'm jumping a few meetings, going on to 12th of June. So you can see here, it is only a 1.6% probability of rates being maintained at the current level, which means 98.4% probability of rate cut of various extent, like 15%, 25 bips, and so on and so forth. So the market is clearly saying that by the middle of next year, starting maybe say March or April or May, whenever, by the middle of next year, we will see significant rate cuts by the US Fed. The US Fed, you know it, the bellwether economy of the world. Inflation is easing. So in 22, the peak inflation was 9.1% in USA. They are CPI inflation. And why so high? Because of this supply chain disruption, sanctions, and all those things. Now, with the combination of base effect, combination of supply chain improvements and rate action, now their CPI has eased to 3.2% from 9.1% of 22. US Treasuries also have eased. So you can see the graph here. Sometime earlier in October, US Treasury 10-year touched 5%, or it's approximately 4.17%. So the market is settling itself to the fact that not much of rate hikes are expected. They are now settling to rate cuts going forward, which is why this steep correction, steep deceleration. So this is something called the dot plot. The official name is Summary of Economic Projections, where the US Fed officially communicates their view. So one dot represents the view of one regional Fed governor. 23, the dots are here. You say 24, the dots are coming down. And 25, the dots are falling further. So basically, the US Fed is officially communicating that rates in 24 and 25 will be lower. We now come to Euro area. Euro area also, we are seeing significant easing in inflation. So 2.4% is the latest data point, CPI inflation in Eurozone. Their high, their peak was 10.6% in October 22, because Europe, they are more impacted by all this gas and other supplies from Russia. So ECB, they have hiked rates significantly. You can see here, they have hiked as much. In the Eurozone, there is no Eurozone yield curve as such. So we use German, they call it Bund, B-U-N-D, German bond yield as the proxy. Here also you can see German bond yields are easing. Basically, they're also looking at rate cuts going forward. Now, this is the Bloomberg Bloomberg data, like I said earlier, imputed probabilities from the traded levels. So similarly, in the Eurozone also, you can see here, the bars are going downward. So basically, the market is settling for projections of rate cuts going forward. So just to recap, we are saying that as per the market view in US Fed, maybe March, April, May, looking at rate cuts. Similar in the Eurozone also, maybe in the similar time period. In fact, we expect the Eurozone to start earlier before US Fed because their GDP is more of a concern than USA. In the entire story, the only exception was China. So even in the post-COVID phase, when inflation was high all over the world, and central banks all over the world were hiking rates, in China, inflation remained low. You can see the data here. In July 23, inflation in China was negative 0.3%. August, they managed 0.1%. September was 0%. And October was minus 2%. So they have issues, real estate and other issues. They're pumping in money and trying to save the situation. So you can see here in 2020 in China, because of COVID, obviously, they cut rates. Now, 22 also, when the whole world was hiking rates, the PBOC, People's Bank of China, they were actually cutting rates. And the inflation was low and they had other issues. Now we come to our India. So in India, you know it, in July, inflation was high, 7.44%, driven largely by vegetable prices. It eased thereafter. You can see August 6.83, September 5.02, October 4.87. November data will come in the coming week, 12th of December. So market calls in the range of like say 5.7, 5.8-ish% or thereabouts, because some vegetable prices are high. Plus, there is this thing called base effect. Base effect means the CPI index in the corresponding month previous year. So base effect is generally positive, but only for 2 months it is adverse. 2 months as in November data coming now next week and December data coming in January. So for 2 months, the base effect is adverse and some prices are on the higher side. So we'll have some blip for 2 months. And thereafter, we again have a positive base effect. And they have said today's RBI policy review, while they have upped GDP production from 6.5 to 7%, they have maintained the inflation projection at 5.4% for this financial year, FY24. They have maintained Q1 of next year at 5.2%. Remarkably, for Q2 of next year, that is July-September, they are projecting 4%, which is bang on the central target of 4%. And quarter after that, they're projecting 4.7%. So inflation projection is benign, 5.4% for this financial year, 5.2% for Q1 of next year, 4% for Q2, and 4.7% for Q3. So this is the gist of today's policy review. Inflation maintained there. We have 2 new data points here or projections here. For Q2, it is 4%, and for Q3, it is 4.7%. And for the last quarter of next year, that is Jan-March 25, RBI's call is 4.3%. So combining all these things, we have a benign environment going ahead. What we see here is the RBI repo rate compared with inflation. So we have various periods. Green zone meaning repo rate higher, and pink zone meaning the inflation rate is higher. Today, repo rate is 6.5%. Inflation last point was 4.87. It will blip for 2 months, maybe 5.5, 6%. It will ease thereafter. Now, coming to the yield curve. Today, the yield curve is very flat. So you can see here, 19th October is the latest data we are showing you here. Yield curve is very flat. So usually what happens is when you buy a bond of a longer maturity, you get a higher yield because you are taking the uncertainty for a longer period of time. Today, the yield curve being very flat, you buy a 1-year bond or 5-year bond or 10-year bond, you don't get much of a yield uptick. So what do? You have to take a bet on research-based corporate bond exposures where you get the yield uptick. We call it the carry. So you have to do your research and buy bonds with a higher carry with a calculated risk. So same thing, the previous slide was sovereign, and this is the AAA PSU yield curve. You can see the curve here, the blue one. The curve is very flat. Now, coming to the previous rate cut cycles. So here, it's very old, September 2000. And when you see this number like 14.5%, it seems like, oh, 14.5, but those days things were different because inflation was very high. Interest rate also used to be high. It was a significant rate cut from 14.5 to 4.5% over this period, 2000 to 2003. And there was a significant rally also in the market in that phase. Another rate cut phase, 15 to 17, it was 1.5 percentage point rate cut from 7.5 to 6%. And 10-year also rallied from 775 to 655. And the latest one, So in the latest rate cut cycle, the COVID phase, it actually started earlier in February 19 when the new governor took over. He started cutting rates, and till May 20, COVID phase, he was cutting rates. It was 2.5 percentage point rate cut, 6.5 to 4%. And there was a rally. Now look at the rightmost column. The rightmost column shows the yield level after 1 year. As in, August 2003, rally happens, 10-year yield becomes 5.3%. 1 year after that, 10-year yield becomes so much, 6%. This rally, August 17, 10-year yield becomes 6.55. 1 year after that, 10-year yield becomes 7.9%. And this one, May 20, 10-year yield was 5.9. 1 year after that, similar, around 6%. So what is the message? If you want to catch the rally, if you want to benefit from yields coming down, you have to do preferably before the rally happens, when the market is building in the expectations, or during the rally. You cannot wait for it if you want to benefit from the rate action. Okay. Now, the second part of my presentation, the environment on credits. So on this, we have a very sanguine scenario here. So we have something called credit ratio, where rating agencies publish their ratio of upgrades and downgrades. So in the first half of FY23, CRISIL ratio was 5.69, and this was the highest. What it means is CRISIL upgraded 5.69 times more instruments than downgrades. So as an example, downgrades 100, upgrades 569, which is significant. The same period, ICRA, their ratio was 3.3 times, and CARE, the other rating agency, their ratio was 3.74%. And it is remarkable because this phase, the first half of FY23, we were just recovering from COVID. COVID, slowdown, recovery, we are in the recovery phase. So in the COVID phase, corporates did a very good job of managing themselves, a very good job of deleveraging themselves, which helped induce rating agencies to improve their ratings. The data is here. So here, this horizontal line is the one. One means equal number of upgrades and downgrades. And you see here. So it may seem like easing, but the point is any number more than 1 is positive. So we had 5.69 here, we had 1.91 here. So basically, the rating ratio remains very positive. Similar data from ICRA. So over this long period of time, so we have 80% reaffirmations and 11% upgrades from ICRA. Similarly, CARE credit ratio, though it's apparently easing, but yes, it is much higher than 1. And they continue to upgrade more companies than they are downgrading. So like I said earlier, corporate deleveraging. So this shows the extent of bank funding of non-financial corporates, and you can see as a percentage of GDP to the extent this is easing. And here we see bank NPS. So bank NPS shot up here post the IBC, NCLT and all those frameworks and all that. Now things are much better. Banks have done recoveries, banks have done write-offs, and you can see the bank balance sheets are much better now, which means from a credit environment, we are much better placed than earlier. Now the next part of my presentation. So when you invest or sell a debt product, on the taxation front, there has been a significant change. In debt mutual funds, for fresh investments from 1st of April this year, short-term capital gains. So in the growth option, we earlier had this indexation benefit. If you invest today and remain invested for 3 years, you used to get the benefit of indexation. From 1st of April 23, in the growth option of debt mutual funds, irrespective of your holding period, all gains are taxable as short-term capital gains, which is your marginal slab rate. Which means in debt mutual funds, you remain invested for 1 day, for 1 year, for 10 years. Your tax rate is your marginal slab rate, which for most investors is 30% plus surcharge and cess. So to put it simply, the indexation benefit has been taken away from debt mutual funds. So where does that lead us to? So if you were to compare a bond PMS and debt mutual funds, one is, of course, we look at returns. So on our product, on the PhillipCapital product, my colleagues will talk more. I will simply only say that PhillipCapital PMS, we are targeting 2.5 to 3% alpha over the 10-year G-Sec. Debt mutual funds being a mass kind of product, they run goodish kind of portfolios, triple oriented portfolios, which have like around 7.5 kind of pre-expense YTM. Or there are mutual fund credit risk funds, which have like maybe around 8.5 kind of pre-expenses YTM. You have the portfolio YTM, which gives you a visibility on the returns in the sense you buy a bond today and you hold till maturity, you get that return. Or you can potentially book capital gains also if you sell prior to maturity at a profit. On the credit quality, at Phillip, we're targeting broadly in the range of AA plus to AA minus. We may buy AAA also, BBB also, but usually the orientation is AA plus to A minus segment. And within this segment, we will look at under-researched companies for the higher carry, the calculated risk. On diversification, people will say that debt mutual funds have a naturally diversified portfolio. Yes. In our PMS also, we have a diversified portfolio and we will diversify further as we go ahead. Taxation, as we have just discussed, just to add a bit to it, for taxation purposes, PMS is a pass-through vehicle. So for investment in bonds, the coupon is taxable at your marginal slab rate. Capital gain for a listed bond for a more than 1 year holding period, the rate is 10% plus surcharge and cess. And for unlisted, you have to hold it for 3 years, and long-term capital gains tax rate is 20% plus surcharge and cess. In debt mutual funds, dividend option, it was taxable any which way at the marginal slab rate earlier. And from 1st April this year, it is now taxable as short-term capital gains, which again is your marginal slab rate. Liquidity mutual funds, yes, easy. And in our PMS also, liquidity will be available in case you require liquidity prior to maturity, it will be made available. So to summarize my portion, we are looking at rate cuts. We are looking at rate cuts starting by ECB, European Central Bank, maybe around March, April next year. Then US Fed, maybe around April, May, June next year. Our RBI, sometime around the second half of next year, because inflation projection is benign. We're talking of 4% in July, September 24. And that will open up opportunities for capital gains, and environment being benign, being sanguine than earlier, and the yield curve being flat. You have to look for investment opportunities and you have to look for better carry with a calculated risk. So now I am here. Now my colleague will talk.
Thank you, Joy. Thank you so much for that, taking us through your perspective. I'm going to take the next part of the PMS of the presentation, where I will introduce you to the PMS. Prior to the introduction to the PMS, I will also talk briefly about PhillipCapital's journey in the fixed income markets. So the slide that you see before you is encapsulates the journey of PhillipCapital as we started our business in the fixed income markets. We entered the fixed income markets in 2012, and it's very interesting to note that our entry into fixed income was a result of a requirement from a customer. A customer actually came to us and told us that they were looking for a good counterparty to deal with on the fixed income side. And I used to service the customer in my previous role as an equity and equity derivative trader at Phillip. The need for a fixed income service provider at that time, coming from a counterparty that was institutional in nature. It was a PMS that had 2.5 to 3,000 crores of assets in 2012, which was a significant amount at that point in time. And they were also backed by a bank, one of the global banks, which was in partnership with one of the local banks here. So that actually was a very interesting situation for us, because we found that a banking entity requiring the services of a fixed income services provider externally was quite interesting. It got us to realize that we were in an oligopolistic market where there were very few market participants that were controlling price and quality. There was a limitation on bid-ask spreads. There was a limitation on the amount of information that was available to end clients. And it was in that environment that we entered the fixed income markets. From 2012 to 2016, we consolidated our presence in the market, and we were more or less a price taker. We continued to service clients, and by 2016, we had gathered enough steam and we were considered amongst the preferred partners for providing fixed income services in the wealth space. We have always been a B2B participant, and hence a lot of you may not have seen us directly dealing with you with individual investors. But the turning point or the inflection point for PhillipCapital came post the credit crisis that took place in 2017, 18, and 19. Whilst we did not have exposure to many of the names that defaulted, we did, however, I must confess, have exposure to ILNFS. ILFS used to have a very popular product, which was a preference share, and would pay 8% or 8.1% dividend at that point in time. The entire industry subscribed to that bond because it used to offer a post-tax return of 8.1%, given that dividends were tax-free in the hands of investors in that regime. But once the default took place on ILFS, it caused a lot of pain across the market. Fortunately, we did not receive any adverse reaction from clients, but it caused us further pain because we realized that when investors park their money in fixed income, they do it for a definite return, and they don't expect any loss on capital. So from there, we started our journey as acting as an arranger. Whilst we never showed clients offers in a lot of the names that defaulted, including the SREIs or the Reliance Capitals or the India Bulls of the world. I know it's not an entity that is defaulted, but the Diwan Housings of the world. We decided that we'll curate our offering further, and we started our journey as a arranger in 2019. The first issue that we brought to market was a paper by HDB, the consumer retail-focused NBFC of the HDFC Bank Group. You would realize that most perps that come to market come with a rating of one notch below the issuer rating. However, the instrument that we brought to market was a 10-year perp and got a AAA rating, which was the same as the rating for the issuer. That paper was brought to us by us to market in 2019, and was something that we have traded as recently as few weeks back. So we continue to stay active in counters that we bring to market. From there, up till 2022, in a period of 4 years, we have brought 14 issuers to market. The 14 issuers that we have brought, we have raised about 5,500 crores, in excess of 5,500 crores. But the actual feather in our cap is that 9 out of the 11 issuers that were non-AAA rated got upgraded. What you see before you is a list of the issuers that we have brought to market. The first of the upgrades took place in Muthoot Finance, and subsequently we saw multiple of these entities getting upgraded. The last of the entities that you see is Capsafe Finance, which actually received 3 or 4 notch upgrade at one go. So that has been the last of the opportunities that we had taken to market in 2022-23. These upgrades are a result of a model that we have developed internally. The model relies very heavily on our research capabilities. And what you see before you is one of the research products that we put out on a weekly basis. This product is called the Running Yield and is penned by Joydeep. The product actually talks about what we believe is relevant at that point in time. So this note was put out on the 25th of April, 2022. I'll take you back to the environment at that point in time. The repo rate was trading at 4% and the 10-year G-Sec was already trading at 7.1. So the spread between the repo and the 10-year G-Sec was about 3.1%. We believe that this spread was not sustainable. And the 10-year average of this particular spread was only 1%. So the outlook that we gave to our investors is, one, market had factored in a large part of the forthcoming rate hikes. A 10-year average of 1% versus a 3.1% spread meant that there would be future rate hikes, but the 10-year G-Sec would not sell off to the same extent as repo rate hikes that were expected. we gave a call that we expect 150 basis points repo rate hikes. Eventually, the rate hike was higher and rates were hiked by 250 basis points. But what we suggested was midway through the rate hike cycle, that means between 75 and 90 basis points, investors should start building duration in their portfolio. The investors who actually took our view and participated by building some duration on their portfolio also benefited because there was some steepness in the curve at that point in time. And as 𝐲𝐸 pointed out a few minutes back, today the yield curve is more or less a flat line with a few chinks along the way. How this eventually played out is hardly 10 days after our note, RBI came and announced an unscheduled policy review. In the policy review, they started hiking rates, and the rate hikes went from 4% on the repo all the way up to 6.5%. Today, as we stand, the 10-year G-Sec trades between 720 and 730. The repo rate is at 6.5%, and the spread has narrowed down to 70 basis points. We again feel that there will be a readjustment, and the readjustment this time will be the spread between the two will expand. The last time we told you it would contract. We now feel that the spread will expand from the 70 basis points to a little bit over 100 basis points. This time, the spread will expand by a reduction in repo rates and will be followed by a rally in the 10-year G-Sec. The second part of the second case study that I'm going to show to you is the impact of credit rating upgrades. A very large part of our strategy in the PMS is to look for companies that are either under-researched or well-priced from an investor's perspective. We have taken this particular example because this almost entirely coincides with the rate hike cycle that in fact, before the rate hike cycle, the market had started discounting the spreads by the spreads increasing. So from November 2021, a period where we actually took to market a bond of Swatantra Microfinance, the first microfinance paper that we had taken to market in almost 10 years of being there in the market, or 9 years of being present in the market, versus a 10-year G-Sec. So when we took Swatantra to market in November 2021, the 10-year G-Sec was trading at a yield of 625 to 630. We've used the on-the-run G-Sec at that point in time, which is the 610 G-Sec, because that would be the most impartial and non-biased indicator. The 10-year G-Sec was trading at a price of close to 98. The Swatantra bond had a monthly coupon, and thereby at 1177 coupon, it worked out to a YTM of about 1242. Within 2 or 3 quarters, there was an upgrade in Swatantra, and it moved up from A+ all the way to AA-. At the same time, rates have started moving higher across the industry, and RBI had already announced its first unscheduled repo rate hikes, which was indicated in the previous slide. So the price of the 10-year G-Sec moved down from 98 all the way down to about 91. When we last prepared this chart in June of 2023, the 10-year G-Sec had recovered from 91 back to 94, and the price on the Swatantra bond had moved up from 103 to 105 odd. So what you saw before you was a graphical representation. The tabular representation is now in front of you. The 10-year G-Sec over the period 30th November 2021 to 30th of June 2023 has actually given you an annualized yield of 1.69%, and that is inclusive of interest. So the coupon payments have been assumed at the 6.1%, and the price movement has been calculated. So you actually made an annualized yield of 1.69%. At the same time, the yield that you have generated on your Swatantra microfinance investment has been close to 15.84%. Numbers can be twisted one way or the other, but to speak plainly, Swatantra has generated a return of about 24%, including interest payments, in a period of 19 months, whereas the 10-year G-Sec generated a return of about 2.5%, thereby generating an alpha of 14.15. This actually brings out one more important point, that everything that is rated AAA or sovereign doesn't necessarily mean that it will give you the highest positive returns. The timing of when you are investing into any security, be it equity, be it debt, is extremely important. Hence, the importance of research in identifying such opportunities is extremely critical. And that is something that we have successfully been able to do through our PMS. So we come straight to the PMS portfolio, the PMS offering. We are calling our offering the Phillip Income Builder Portfolio. The Income Builder Portfolio was launched on the 28th of August. What the strategy of the Income Builder Portfolio is to identify companies with a good track record. For us, the starting point of any investment is to look at the promoter. The promoter's track record, the promoter quality, the management quality are the starting point of any company or any investment that we analyze. Once we look at a good, well-managed company, we look at their track record, the way the numbers stack up, the balance sheet, and finally, we look at the yields, how attractive it is to comparable opportunities in the market. The second thing that we look at is our investment themes. So we have successfully had a few investment themes over the years. One of the investment themes that we have successfully played very well is we look for smaller companies which are part of a larger and well-established group. Swatantra, the example from our previous slide, is an entity that is promoted by Ananya Birla, the daughter of Mr. Kumaramangalam Birla and part of the AV Birla group. Similarly, we have also brought to market issues from Tata Motor Finance, from Belstar, and other such issuers. So we have always been conscious of the quality of issuers that we brought to market, and these issuers have played out extremely well for us. The second thing that we look at is a good company going through a tough part of a economic or sector cycle. A case in point would be Shriram Transport in 2020-21. When we first took exposure to Shriram Transport in 2020-21, collection efficiency had crashed because you'll remember in phase 1 of COVID, there was hardly any movement of goods and services. And in such an environment, a company that funds such transporters, their collection efficiency had dropped. However, one of the indicators that we look at or we track very closely is called collection efficiency. Collection efficiency is a monthly data that is put out by an NBSE to say how much of its outstanding that was collectible in a particular month has been collected. So there was a sudden jump in the collection efficiency for Shriram Transport. From that time, we have successfully raised about 2,000 odd crores for different companies within the Shriram group, including the erstwhile Shriram City Union and the only MLD offering of Shriram Housing Finance. The third one that we look at is opportunities that are a result of special situation or a regulatory change. I remember when there was a write down for the Yes Bank perp and subsequent events that took place for Franklin Templeton curtailing its withdrawals. There was a sell-off in the AT1 or the perpetual bond market that created a dislocation in the market. In addition, as a result of that event, there was a change in the pricing methodology, and that change in pricing methodology for AT1 or perps, which was done for the domestic mutual funds, caused further selling pressure. So some of these opportunities that were available at that point in time were extremely attractive. An example is so the 4 AT1s that were on our approved list at that point in time, actually there were 5, but 4 we participated in very wholeheartedly. HDFC Bank was available at 2-year HDFC Bank papers were available at a yield of 9.5%. SBI was available above 10%. ICICI Bank was available at 10.5%, and Axis Bank was available at a yield of 11.5% plus. These are all papers with 2 to 3 year residual maturity. There was no significant impact on the business of any of these entities. It was only events around the asset class which caused the sell-off. And given that the numbers of all these entities continue to be supportive and strong, we actually had a lot of our investors participate in these companies. The fourth is we look at opportunities of securities that are available at a historical spread. and have a similar credit rating. So these spreads actually help us identify which companies seem more attractive than the others. Sometimes they are also a warning of which companies to stay away from. An example is there was so for example, Diwan Housing, despite being AAA, always continue to trade at the highest spread compared to any of the other AAA rated entities. So you have to be able to decipher between the two of them to see whether this is a value trap or whether this is a good investment opportunity. The third thing that we do in our investment strategy is we look for alpha, and that alpha comes as a result of capital appreciation. So a very large part of our strategy is looking for companies where there is a rating upgrade potential. And this rating upgrade potential could happen for any amount of reasons. One very obvious reason is improvement in the business performance of these companies. Two, some corporate action that may lead to an upgrade. This is also a special situation which was mentioned in our previous point. A special situation is one of our companies in the portfolio has a special situation where a A-rated company is getting acquired by a AA minus rated entity. And the result is that on merger or on completion of the acquisition, which has taken place recently, the entity will actually get a large capital gain, a large revaluation in the levels at which it trades, which will lead to capital gain. What a capital gain does is it leads to more demand for the same security as investors start to take positions. The third thing is obviously that we will modify our strategy from time to time by changing the duration of the portfolio basis our view on rates in the short to medium term. The end result of this investment strategy is we should be able to generate a post-expense alpha of between 2.5% to 3% over the 10-year G-Sec. I say this with a certain amount of conservatism because we believe that we should be able to do better. But from an expectation setting point, we believe that we should be able to generate more than 2.5% to 3% over the 10-year G-Sec. The next slide that you're looking at is our selection process. Whilst it's not possible for me to actually bring the entire methodology in front of you, but this is broadly how we look at selecting companies. I mentioned in my previous slide as well that we look at promoter quality, and one of the biggest indicators for us is how the promoter has behaved in a bad part of the cycle. Every business will go through ups and downs. Every business will go through cyclical downturns, and through those cyclical downturns, promoters will continue to display their integrity and character. These are things that are a big red flag or a big thing that we watch out for. Hence, we look at companies with a certain amount of history. You will not find companies in our portfolio that have come into existence over the last 2 to 3 years. The second is the company that we look at within the sector. Very often, we will not look for the largest company within the sector. We look at a number 2, a number 3, a number 4 within the sector because they offer a significantly higher alpha than what you will get by investing in the largest company. 3, the due diligence. Now, this is a very diligent. This is a very exhaustive process, and this exhaustive process includes, like I mentioned, the qualitative factors, but the quantitative factors, which most of us in the market look at. I can't say that the quantitative factors are unique only to us. For us, we look at various things on the quantitative side, which includes the product that the company is into. If it's an NBFC or if it's a manufacturing company, what is the presence? How well diversified is it? How granular are the loans? What are their sourcing and underwriting processes? What is the collection methodology? We look at ALM. We look at how well diversified the resource profile is, which means how many lenders do they have. We look at capitalization, we look at asset quality, so we look at collection efficiency. So there is a lot that we do on the quantitative part. On the qualitative part, one looks at the promoters, like I mentioned before. One looks at the governance or the experienced board, if available. We look at special considerations. you saw I spoke of a company where there is a merger which is leading to a rating upgrade. There is also entities which either may be approaching market by coming to market to list and tap the equity market, or maybe applying for something like a universal banking license, which is the case with one of the companies in our presentation, in our portfolio. Whilst we are doing this, I must also say what we are not doing. We are avoiding companies that, even though may be available at attractive levels, are extremely leveraged or stressed. We are avoiding companies in the real estate space completely. The reason for that is these are companies that have had a checkered track record, and we feel that to deliver the return profile that we are hoping to deliver to your customers, we don't really need to take exposure to these companies. They have historically been a pain point for the largest of investors, hence we stay away from them. The final part, and this is probably the most important and least appreciated part of what we do, we spend a lot of time in trying to construct a strong term sheet. The term sheet is constructed while building very strong covenants which provide us an exit. Today we have 7 companies in our portfolio, and 6 out of those 7 companies either are secured or have certain covenants which give us an exit in case of a worsening in performance of the issuer. So we spend a lot of time and a lot of effort, and this effort sometimes will result in us giving up a part of the yield. But given that the secondary fixed income markets, especially the stressed debt market, is almost absent in India, you will benefit much more by creating a strong term sheet and giving up a few basis points, especially in the case of a credit event. In addition to that, the quality of collateral that we take is extremely important. I very often interact with people who are not differentiating between either a gold loan company and a microfinance company of the same rating, because they feel that a microfinance company is offering 100 basis or 200 basis points higher. They do not appreciate the benefit of investing in companies which have a solid business model and backed by good high quality collateral. So the portfolio that we are constructing will have exposure right from AAA to A- to actually BBB minus. But in reality, we are building a portfolio of securities between AA and A minus. We have the approval to invest up to 10% of the portfolio below A minus, that is a BBB plus and lower. But in reality, we have not exercised that option at all. The portfolio that is now stable and has been around for the last 3 months on has delivered a superior return, even by investing in securities that are between AA minus and A minus. From time to time, we will over and under allocate to securities, but we will not take any exposure to real estate. Like I mentioned, the other no-go or check for us is fintech companies. You would recollect I said a couple of minutes back that we like companies with a certain amount of trading history. We like companies where the promoter has been around for a long time and continues to stay committed to the business. Companies that are chasing profitability whilst doing their business ethically. A lot of fintechs that we've analyzed look to maximize valuation, and for valuation maximization, they're looking for turnover as opposed to profitability. Our focus is always to look for companies that are run efficiently and profitably. So all the companies in our portfolio are profitable and are exposed to multiple institutional counterparties. So on the fintech side, we have capped exposure at 20%, but as we speak, our exposure is only 10%, and we expect to keep it around these levels. The portfolio will consist of a variety of instruments, which includes bonds, NCDs, MLDs, and quasi-fixed income instruments like REITs and InvITs. From time to time, we'll take exposure to short-term instruments for liquidity management. A predefined exit strategy is very important from the perspective of risk management. So when we initiate any particular trade, we try and define a price or a YTM at which we would like to exit. All of this is done with the objective of making a certain amount of capital gain on your portfolio. And we actually believe that your fixed income portfolio not only should provide you a certain amount of safety and principal protection, but can also provide you capital gain. This is something that is core to our entire investment philosophy. So we define upfront where we believe the security should trade given certain events taking place. When that security reaches that price or that YTM, then we will reevaluate whether we want to stay invested in that security or no. One thing I must say here, and this is a question that may come up at some point in time, this level is not only a level in terms of an absolute number, but it is also going to be a number relative to where the market is trading or where the 10-year G-Sec is trading. Another exit point that we look at is in case there is a rating downgrade. I mentioned that 6 of 7 opportunities that we have actually has a provision for is either secured or has certain covenants. Some of these covenants include a 1 or a 2-notch rating downgrade resulting in an accelerated redemption. The value of this accelerated redemption is felt only in the case of a credit event like a downgrade or a default, but the impact of that is extremely high. So one is very, very careful about building a term sheet, and you not only get an exit in case an event of this kind takes place, but you get an exit at par. Which means that you are not selling at stress prices. So event of this kind, we will seek protection for where possible by creating or including such covenants in the term sheet. The third is obviously finding an opportunity to invest that capital. So it may so happen that a security that I've invested in at 10% now has fallen to 9% and gives me an opportunity to book capital gain. But at that point in time, whether we have another opportunity which will be of a similar credit quality and will give a better yield to our portfolio is something that we look at. So these are the key terms of the Phillip Income Builder portfolio. The portfolio has a minimum investment of 50 lakhs for the growth option, and we also have a regular income option where we have kept a minimum investment of 55 lakhs. We are benchmarking this against the CRISIL Composite Bond Index. Whilst we are charging a management fee of 0.75%, a custody and fund accounting fee of 10 basis points, and we are charging no performance fee. The thought process behind this is so that we don't take excessive risk just to get a higher fee for us at PhillipCapital. This said, we are charging an exit load of 1% if exited within the first 1 year. And the reason for that is we believe that the entry point or the time of launching of this PMS is not incidental, but actually on design. We feel that we are on the verge of a rate cut cycle. The credit environment is conducive, and if investors stay invested for a period of 2 to 3 years, they will see double-digit returns. And these returns will be much higher than what they have experienced in the last 2 to 3 years. We have chosen Axis Bank as a custodian, and the depository account is maintained with PhillipCapital. So I'll just take you through the key personnel. The fund management team to start with. Vaibhav Singhal, who is also on this call, is the fund manager. He is supported by Nishit Shah, who heads the PMS team, and is a co-fund manager. Vaibhav brings to the table a unique combination of someone who has a good understanding of both rates and credit. It's very unique in our industry where people have a good understanding of credit and rates both, and Vaibhav brings that to the table. Prior to working with us, which he has done for the last 4 years, he has spent about 11 to 12 years with ICICI Bank in the Treasury and bond trading teams. So he has the institutional experience and understanding which greatly assists us. Nishit has been part of the markets for the last 17 years, and he's been part of the of the sell and now buy side. He has run very successfully an equity PMS for us, and will support Vaibhav in his fund management exercise. I must take you through what I believe is a very important facet of our presentation, the investment committee. The investment committee will show you the seriousness or the commitment of PhillipCapital, not only by launching a product on their team, but by having the senior most members of the company being part of the investment committee. So the investment committee includes Vineet Bhatnagar, who is the CEO of the company, Rajendra Bhambani, who is the CEO of the company, Nishit and Vaibhav, who are the fund managers, our CFO, Nihit Parekh, who brings in his insight and understanding of financial statements, and Rohan Raut, who is our head of compliance, who also provides his understanding and experience in legal and compliance matters. Prior to working with us, he spent 16 years, with NSE. This is the voting part of the committee. The 6 members that you saw before you is the voting part of the committee. The voting, the investment committee must pass any investment decision by the vote of 4 out of 6. So a majority vote is sought, and 4 out of 6 members must approve an opportunity. There are 3 parts who 3 members of the domain expert team. Manish Agarwala is our co-head of research. He covers banking and financial services, and is one of our star analysts. Joydeep, who is also with us on the call, and extremely experienced and a very well known and recognized name in the fixed income markets, and myself. So now coming to the last part of our presentation. There is a reason why we are bringing this particular product at this point in time. Currently, yields are elevated. We are investing in an environment where we feel that we are at we don't expect yields to move any higher. In fact, we expect a fall in interest rates over the next few quarters. And with this, there is an opportunity to capture rating upgrades, which will further cause capital gains on the portfolio. So the investment in higher yields will give you steady returns, which are attractive given the current market environment. A fall in rates and the rating upgrades will create capital gain, and as a result of these, you are likely to see double-digit return. But the most important part is you will see double-digit return with lower volatility. So that is something that we are capturing by investing in fixed income at this point in time. So this was the essence of our portfolio and our presentation. I would request the PMS Bazaar team to take the questions of the investors. I believe that we have quite a few questions.
Yes, we do have. And also, thank you, sir. Thank you for one elaborate PPT. I think we could understand all about fixed income. Of course, and I must say it was a very elaborate one. So I don't want to take much time. Let me just directly jump into the Q&A. So for the first question which I had after this PPT, after this PPT shown was like, if you could show some performance of your fund, or if we talk about your performance of your fund, how has it performed and how has it been for the investors?
I'll take that. Thanks, Akshara. We launched our fund on 28th of August 2023, and it has been as on since from as on 28th of August 23, if the returns which we have made up till now as on yesterday is 3.6% on on the portfolio. So the return as on inception is 3.6%. The 1 month return is about 1%. And we have a strategy in mind where there'll be we are targeting 1% return every month. The overall portfolio is making a YTM of close to 11.70%. with a modified duration of around 3, which we plan to increase as we have spoken about. We expect interest rate to fall. Then we plan to increase the duration from 3 to 3.5 over the next couple of months. And so that's in a nutshell is what we are targeting. 1% return every month without, this is just to tell you again, this is without accounting for any appreciation which will come out of any rating upgrade, which we expect to happen in the next course of 12 to 15 months.
And one more question, just it's a follow-up question, more like that. If an investor is going to invest 50 lakhs, like how is the fund going to be deployed? Do you sit on cash or something? I just
No,
want to
so
ask.
we usually, whenever an investment is made into the fund, we try to deploy the fund on the same day itself, so that investor doesn't lose out on even a single day interest. But while I say this, only when there is a basket of securities which we are comfortable with, only then we will utilize the full fund, and we might keep some cash from time to time, depending upon whenever, if suppose there is a dearth of quality securities which are available or which are not available. But the effort is there to not keep even a 1% cash in the portfolio, and to deploy to a larger extent whatever we can.
Okay, so how do you manage default risk?
Pardon?
How do you manage default risk? Because the default risk is a major, basically like a risk mitigation.
So good question. So as we have spoken, Kunal, took us through the steps or the process which goes through while curating up, or while coming up, or while we invest in a security. So there is a lengthy process which takes 1 or 2 months while finalizing or while onboarding an issuer on our platform. And while after going through this rigorous process, we are not only stops at that. We try to inbuilt strong term sheet. So what that helps us is that in any kind of a downturn which starts in any company, that kind of gets captured in a way by financials or in the rating metrics. So when a financial of the company gets start to deteriorate, there are certain financial covenants which we try to inbuilt into the term sheet, which if suppose gets deteriorated, then it calls for an accelerated redemption. If it is not cured within a span of, let's say, 1 or 2 months, then the issuer has to repay the money to the investors within a span of 15 or let's say 30 days, depending upon the term sheet. And that's how any stress is captured early, and that helps the investor to get their money back before anything starts to go worse.
Okay. Thank you for that. And let me just quickly jump on to the questions that is falling on the podium. Does name Mr. N wants to know what will be the estimated annual return per year? Will the interest be paid to us separately? What can we expect in hand cash returns every year on investment done? What will be your charges? Like everything put together. Yes, made into one question.
Sure. Let's take that one by one. Just let me also browse through.
No, I can take the question one by one.
Yeah, sure. Okay.
Yeah.
So what
the
will be
first
the
question-
estimated? No,
Yeah.
I've looked at that. So what will be the estimated annual return per year? So as I've just spoken about that we are targeting 1% return every month. So we are looking at, and the YTM of the portfolio is around close to 11.7%. And we have, although Kunal spoke about that, we are targeting 2.5 to 3% alpha over 10-year G-Sec. That, works out to G-Sec 10-year is at 725 right now. And that gives us a number of close to 10% or so, 10 to 11%. But realistically speaking, we kind of our estimate can give an estimate of close to 11.5 to 12% kind of a overall ballpark basis gross return per year. Then the interest will be paid to us separately. So there are two plans which we have. One is the growth scheme, and the other one is regular income. In the growth scheme, so most of the papers which are there in the portfolio, there is a coupon which is paid out on a monthly basis. So in the growth scheme, that coupon will get reinvested. whenever it is paid out. And there is another scheme which is a regular income scheme, in which every month, on the 12th of every month, once an investor has completed a full month, then starting the cycle starts from there, and on the 12th of every month, whatever coupons get accrued, they'll be paid out to the investor. So these two schemes. So it depends upon which scheme the investor has invested upon.
Okay.
Then what can we expect in hand cash returns every year on investment done? So again, this is something which is similar, which is already answered. What will be your charges? So we have spoken about our charges. It will be 0.75%. And plus there will be nominal charges of custody expenses and all that, which will be 0.10%. So it is 0.85%.
Okay, so moving to the next question from KV Ramani, was that what is the alpha for the next 10 years as per your estimate?
Alpha, so see, what is our plan now? I'll tell you. Then there are currently 7 securities which are there in the portfolio. Okay. Our idea is that at least 2 to 3 securities out of these 7 will get, at least I'll talk about the near 2 to 3 years plan, that we are expecting around 2 to 3 securities out of this portfolio to get upgraded in the next 12 to 15 months. And if we just do the numbers with a modified duration of on an average of 3 years, of the securities, and these 3 securities, comprising around close to 50% of the portfolio, 50 to 60% of the portfolio, we are looking at an alpha of 2%, around 1.5 to 2% only, at least, this is, I'm talking about, in the next 2 to 3 years.
Okay, so let me just move to the next question quickly because of the time constraint. I'm just taking the question. Any new sector identified for super normal gains like power or power financing?
We so there is a constant evaluation going on. Whatever opportunities we get, we also have a pool of issuers which we have identified, or which we constantly try to update, or we try to add, or we try to remove. We try to monitor the performance of the companies sector by sector. We have a very large equity research team who gives us updates, on what is the outlook of each and every sector over the next 2 to 3 years. So it's a evolving process, basis which we tend to decide if suppose we want to go for this particular sector, or it's a evolving process.
Yeah, got it, sir. So, like when Kunal sir was talking about customized portfolio. So, if you could clarify more on it, can you just clarify more on customized portfolios?
Yeah, so I'll tell you. So this question actually has come because somebody asked that whether NRIs can invest in the product. So NRIs can't invest in the regular product, because the reason I'll tell you, because there are securities in the portfolio which are not eligible for an NRI to invest in. So there is a restriction. Although 50 to 60% of the securities which are there in the portfolio are eligible. So what we will do is, we will, on a case-to-case basis, if suppose any NRI or anybody else, for example, there is a requirement for a portfolios to be customized, like from a AAA segment, some push allocation has to be done, AA segment, some allocation, and then AA minus to A minus, there is allocation which anybody wants only to the extent of 50%. So we can, what we have a system in place where we can we do a customization of that particular portfolio, and we can, select the securities according to let it be an NRI. So we can only, give securities which are eligible for NRI. Or if suppose somebody wants a specific credit rating related portfolio, then we can do that as well. That's what is meant by customized portfolio.
Okay, so the next question was like from Umesh. A question reconvent, like how do they work in reality, as in a tech downgrade would typically happen if the issuer is going through a poor phase and has cash flow challenges. Like how would it be positioned to repay the premature redemption?
just come. I didn't understood the first part.
Like like a question not reconvince, like how do they work in reality? As in a tech downgrade would typically happen if the issuer is going through a poor phase and has cash flow challenges. And how would it be to position repay the premature redemption costs?
Okay. I'll ask Kunal to take this.
Yeah, Umesh, to answer your question, uh, we don't rely only on covenants to manage the portfolio in case of a stress situation. Each issuer that we look at, we have a regular interaction with the issuer. We study numbers that come out. Some of this data comes out on a monthly basis, like the collection efficiency that I spoke of. Most of this data comes out on a quarterly basis when the company comes with its quarterly numbers. So the process is an ongoing process and doesn't happen on one day and then we shut it and forget it. So we keep evaluating the different factors. We keep looking at the numbers. We look at the environment. Hence we are able to manage. But regarding covenants, covenant is supposed to protect you or is to ensure that the company maintains a certain amount of liquidity, a certain amount of collection efficiency. It does not have a change in promoter shareholding. All these things are not only monitored by PhillipCapital's PMS team, but also the debenture trustee that tends to that has the responsibility of monitoring these variables. So in case of a breach of any of these variables, the company is made responsible not only by PhillipCapital but the debenture trustee who has the collateral in place to cause a liquidation.
Okay, thank you. So I'll just take the last question because we can see people dropping off. So I will just take the last question for the day. It was like from Kamal Chopra. Please clarify the tax impact again. For example, if someone holds an investment for 3 years and he'll pay long-term capital gain tax rate.
Right. So all the instruments that we are investing in are listed instruments. The current taxation on a listed instrument is if held for a period of greater than 1 year, the capital gains will get taxed at 10% plus surcharge plus cess, not 3 years. And the interest income that is generated is taxed at your slab rate. So since the PMS is a pass-through entity, any taxation that you are liable for will be paid for by you, and the cap gains will only get taxed at 10%. It is a significant part of our it is a part of our overall return, but the significant part of our return comes from interest income.
Okay, so thank you. Because of the time constraint, we have come to the end of the webinar. And I would like to extend the heartfelt gratitude to all the speakers and each attendee to make this event such a successful one. But remember, like learning is a continuous process. Let's keep exploring, innovating, and growing together.